This stock soared 600% in 3 weeks after its IPO. Some say it could double again, others say it's due for a collapse. How can the same company be called overhyped and undervalued in the same breath? Today, we're diving into Circle, the company behind the fastest growing stablecoin in America and possibly the quietest financial weapon the US has ever built. In 2022, $60 billion disappeared in just 1 week, not from a war, not from a bank failure, from a coin called Terra. For hundreds of thousands of people, it wasn't just money. It was retirement, tuition, rent, and it was gone. While the world pointed fingers at one man, Washington was already drawing up a new plan. Because what collapsed wasn't just a token, it was trust. And what rose next would be something far bigger, a new system, one built not on dreams, but on debt. This is the rise of Circle, the coin that may quietly help America manage $2 trillion in debt. So the question isn't just what Circle is, it's how you prepare for the system that's coming. Welcome back to Investment Club, no fees. Terra promised to be the future of money. A stablecoin, pegged to the dollar, held not by traditional reserves, but by a clever algorithm tied to its sister token, Luna. Here's how it worked. When Terra's price dipped below $1, users were incentivized to swap Terra for $1 worth of Luna, burning Terra and shrinking its supply to push the price back up. If Terra rose above $1, users could mint new Terra by exchanging $1 worth of Luna, increasing supply to bring the price down. There was a closed-loop balancing act, run entirely on code and market incentives, with no real assets backing the value. For a while, it seemed revolutionary. But when panic set in and demand for Terra plummeted, the system collapsed. There wasn't enough real value to stop the death spiral. Luna hyperinflated, Terra depegged. $60 billion in value disappeared almost overnight. The headlines screamed scam. But in Washington, something else quietly took shape. The seeds of regulation had already been planted, but Terra's collapse lit the fuse. In the months that followed, policymakers began drafting what would become the Genius Act, finally passed in 2025. It wasn't a rushed response, but a methodical blueprint to rebuild trust. A framework that said, no more algorithmic illusions. Stablecoins must be backed by real, transparent reserves. It wasn't just about preventing another Terra. It was about integrating stablecoins in the heart of US financial strategy, not just to stabilize crypto, but to stabilize debt. One that served not just traders, but the US Treasury. As other crypto companies ducked regulators and spun wild futures, Circle did the opposite. They walked straight into the storm. They welcomed audits. They partnered with BlackRock. They opened their books to Wall Street. Why? Because they understood something no algorithm could replicate. Trust is earned. Their stablecoin, USDC, is backed not by code or hype, but by US dollars and short-term treasuries. Nearly 40% of their reserves, about $20 billion, sit in T-bills. The rest is in cash and ultra-liquid assets. It's boring, it's conservative, and it's exactly what Washington needed. When the Genius Act passed in 2025, mandating one-to-one backing with real assets, Circle didn't scramble to comply. They were already compliant, but their play was never just about regulation. Here's their real secret. Every time someone buys a USDC, Circle takes that dollar and buys a treasury. Repeat that across millions of users, and Circle becomes something far more powerful than a payments platform. They became a pipeline, converting global demand for digital dollars into quiet, consistent demand for US debt. In a world facing a $44 trillion US debt load by 2028, that pipeline isn't a tech gimmick. It's a financial pressure valve. The Genius Act didn't just regulate crypto, it embedded it into the American bond market. And Circle? They didn't just play by the rules, they helped write them. The United States is facing an unprecedented fiscal cliff. By 2028, national debt is projected to reach $44 trillion. The usual buyers, foreign governments, pension funds, and money markets, are either saturated or increasingly cautious. And after years of draining liquidity through rate hikes and bond rollovers, even the Treasury's own tricks have run thin. In early 2025, the Trump administration was staring down a daunting reality. Over $2 trillion in new bond issuance was needed by year-end. But if they issued too many long-term bonds, yields would spike. If they leaned on short-term bills, they'd risk destabilizing money markets. That's when the Genius Act became more than a regulatory bill. It became a fiscal escape hatch. By requiring stablecoins to be fully backed by short-term treasuries and cash equivalents, the US created a new, organic class of treasury buyers, driven by global demand for fast, cheap digital dollars. In theory, the more people adopt stablecoins like USDC, the more treasuries get bought. It's elegant, it's quiet, and it doesn't spook markets. But there's a catch. Stablecoins don't create new money. When dollars move into USDC, they often come from bank deposits or MMFs, pulling liquidity from elsewhere. Worse, those dollars don't circulate. They sit. Unlike banks, stablecoins don't lend. So while they create demand for treasuries, they also risk draining credit from the real economy. Still, from a policymaker's perspective, it's genius. A hands-off way to fund rising debt without spooking the market. A self-funding treasury loop powered by digital wallets. And in a time of record deficits, maybe that's just the kind of quiet magic Washington was hoping for.
This isn't just about a coin, or a bill, or a company. This is about the quiet transformation of the entire financial system. We're entering a world where money no longer needs banks, where dollars no longer need to move slowly, and where trust isn't given to institutions. It's programmed into code. In the old economy, central banks pulled levers, Wall Street intermediated everything, and government debt relied on legacy buyers and old tools. But now, liquidity flows through APIs, debt is absorbed by algorithms, and monetary power shifts from physical banks to digital rails. And the impact doesn't stop there, because interest rates too will behave differently. In the past, the Federal Reserve had blunt tools, adjust rates and let the ripple spread. But if more liquidity gets trapped inside stablecoins, earning no interest, circulating less, then monetary policy gets distorted. Lowering rates might not stimulate lending the way it used to. Raising rates might not slow spending if credit no longer runs through traditional banks. Stablecoins could dull the Fed's ability to steer the economy, just when we need precision the most. Circle isn't just a player, it's the prototype. The prototype of an economy where your savings, your credit, and your currency live in programmable wrappers, optimized for statecraft as much as settlement. So, what now? As an investor, is Circle a once-in-a-generation opportunity or a story that's already priced in? Wall Street remains sharply divided. Goldman Sachs and JP Morgan have issued cautious reports, arguing Circle's valuations overheated and over-reliant on high interest rates. Their core concern is simple. Circle's revenue today is mostly driven by interest income from reserves, U.S. Treasuries held behind USDC. If interest rates drop, that income stream could shrink dramatically, and its other business lines aren't yet strong enough to fill the gap. But Bernstein sees something entirely different. They've initiated coverage with an outperform rating and a bold price target of $230. Why? Because they're not valuing Circle based on today's rates. They're valuing it based on what Circle might become. Bernstein argues that Circle is becoming the digital infrastructure for a new kind of economy, one where real-world assets are tokenized and transacted globally through stablecoins. They believe Circle's early mover advantage, strong regulatory footing under the Genius Act, and deep liquidity position USDC as the default currency for future digital markets. Not just in crypto, but in tokenized real estate, bonds, even intellectual property. Their forecast assumes the stablecoin market will grow from under $250 billion today to $4 trillion in the next decade. And they believe Circle will be one of the few companies equipped to dominate that space, especially if tokenized assets become mainstream across capital markets. So what do you believe? Is Circle a future utility grid for digital finance, or a well-positioned placeholder riding the interest rate wave? One thing's clear, Circle is no longer just a bet on crypto hype. It's a bet on the system itself. And in an age where governments are redesigning money to solve debt, power, and policy, betting on Circle is really betting on how far that redesign will go. That's the opportunity and the risk. So here we are.
a $60 billion collapse that became a $2 trillion opportunity. A startup once seen as a crypto side player, now central to the future of debt, interest rates, and even monetary power. Circle didn't just survive the storm, it aligned with it. And if that alignment holds, the ripple effects could reshape everything, from how we invest to how nations fund themselves. But this isn't the first time macro policy shook the foundations of investing. In our previous video, How Tariffs Threaten Dividend Stocks and What to Do About It, we broke down how global shifts are already hitting individual portfolios and how to defend your income in uncertain times. If you're wondering how to position calmly through all this change, that's your next stop. Tap above to watch it now. And remember, investing isn't about predicting disruption, it's about preparing for what survives it. You're watching Investment Club, no fees. See you in the next one.